Okay, today we're going to talk about job order costing systems. Job order costing systems are used when each customer has unique specifications that are different from other customers. And so, for example, a cabinet maker has to go in and measure the unique dimensions of each and every kitchen and the preferences of each customer. So cabinets are going to be different from house to house. Okay? And so we have a lot of different companies out there that will use a job order costing system. Notice for party invitations, wedding invitations, graduations. Okay? You might invite 150 people, you pick the design, the look, the specific information. That's a job order. Movies are obviously going to be different from movie to movie, so that's a form of a job order. As opposed to process costing. Process costing is for companies that manufacture the exact same product day in, day out, month in, month out. And so we use a slightly different method for accumulating costs and determining the cost of our product. This chapter we're going to focus on job order systems. All right, now remember, the flow of work in any company is raw materials get requisitioned into the production area. Requisition, simply a request. So we receive a customer order, and that generates a production order. And we're going to need raw materials, both direct and indirect. We're going to, of course, add labor, and we're going to incur various overhead costs in the production process. While we're manufacturing our products, it's called work in process. When we're finished with the production, it becomes finished goods, and then when we sell the inventory, it becomes part of cost of goods sold, which again is an expense. So in a manufacturing environment, we have three types of inventories. We have raw materials, work in process, and finished goods inventory. Now, when we talk about work in process, I'm just going to abbreviate WIP, work in process, or WIP. This is what's called a control account. Okay, we see control accounts a lot in all businesses. Accounts receivable. For example, if you looked at the financial statements, the balance sheet of American Express, you would see one line item called accounts receivable. And it's going to be in the billions of dollars because there must be 30, 40 million people with American Express cards. But they're not going to show you all 40 million. Obviously, that would be ridiculous. They're going to show you one number. But they keep track of all of us. We wish they didn't, then we could spend and not have to pay our bills. But each and every customer in the what's called the subsidiary ledger, okay, we all get our little mini T accounts. And when you add up all the balances, it'll equal the balance in work in process, the control account. Now, with work in process, the subsidiary ledger are all the various job cost sheets. Okay, so here's job 1, job 2, job 3, job 4. Let me make these a little bit larger. And as we're working on jobs, and you can be working on more than one job at a time, you are going to record all the direct materials that go to each and every job as you requisition them, and a requisition is simply a request. Your direct labor costs, and we assign or apply overhead costs. These are the three product costs. Now, if we add up all the direct materials for all open jobs, that's what this number equals. Same thing with direct labor. Add up the 4 jobs direct labor, and that's how much direct labor is in the work in process control account, and of course, the same thing for overhead. Okay? So, anyway, you want to be comfortable with that concept, but each job that we work on will have its own job cost sheet, and as we're working on it, we will accumulate those costs. Now, let's look at the journal entries in a job order cost system. And you'll see similarities when we looked at financial accounting. Now, when we buy inventory, we simply debit inventory. This is no different than in financial accounting. We simply called it merchandise inventory. Now we're calling it materials inventory. And if you see a journal entry that just says materials, you can assume it's materials inventory. And so we're going to debit inventory because it's an asset. And when an asset increases, we debit it. We're either going to credit accounts payable, AP, accounts payable, or cash, depending upon whether we pay cash or we bought it on account. Now, when we requisition materials into the production process, if it's direct materials, notice we debit work in process for direct materials, but overhead costs first go into the overhead account. Excuse me, indirect materials. Indirect materials go to the overhead account, all right? And notice we're going to credit the inventory since we're pulling it out of the raw materials inventory, and now it's going into work in process inventory, okay? But overhead, we make a pit stop in the overhead account, and we're going to accumulate all those various overhead costs, and then we will apply them using that predetermined overhead rate. Okay, same thing with labor. Now, we don't have inventory of labor, obviously, but as we incur labor costs, we designate direct labor as a direct debit to work in process, and then we debit overhead for indirect labor. Remember, indirect labor are things like supervisor salaries, the mechanics, the cleaning crew in the factory, etc. And, of course, we credit wages payable. Okay, so now we're accumulating costs. We've accumulated the materials costs and the labor costs. Overhead, of course, is a little trickier. Okay, remember, overhead is all production-related costs other than direct materials and direct labor. So it's an awful lot of stuff that we can call overhead costs. We got the depreciation on the factory, on all the equipment in there. We got the rent or the lease. We have utility costs. We have property tax. We have insurance. We have the quality control department. We got purchasing. We got the cleaning crew, the security guard, all the indirect materials. Lubricants, fasteners, etc. So there's a lot of different overhead costs that we have to keep track of. All right, notice certain costs like straight line depreciation and supervisor salaries can be easily identified and allocated to the products that we produce. However, other costs such as lubricants for the machinery, insurance and property tax on the factory, cleaning supplies, and other overhead costs are difficult to assign to the individual products, which is why we have to create what we call a predetermined overhead rate. Okay? And once we determine this overhead rate, we're then going to transfer these costs, and the term that we use is we're going to assign or apply these overhead costs to WIP using this overhead rate. Okay? And our overhead rate is, the numerator is estimated annual overhead costs divided by estimated annual activity. So how do you know your estimated annual overhead costs? Well, if you've been in business for a while, you simply look at previous years and you look at the production levels. You project in your budgets how much you're going to produce this year, and from that you could get a fair idea of how much it's going to cost you in overhead. Now, you always have to keep your eye out for changes in your work environment. If you have new equipment, if you've had a raise in people's salaries, if energy costs have gone up, then you need to keep an eye on the assumptions you made when estimating these costs. You need to update your information. Activity is any activity that we notice causes an increase in overhead costs being incurred. And historically, the activities that we've identified a direct correlation in terms of activity increasing and overhead cost increasing are things like direct labor hours, when it's a labor-intensive product that you're building, or machine hours if you have a lot of automation. Sometimes you'll use actual units of inventory produced. You might even use the cost of direct labor, what we call direct labor dollars. Okay, these are the four most common activities, and these are the ones we'll use for discussion purposes. There are others. Okay, so we decide on a cost driver, and the term we use is a cost driver, and this is the relationship, the cause and effect relationship that we're going to use to apply overhead to work in process. Okay, now, this is my overhead T account. Okay? Notice, all overhead costs debited to the overhead account are actual costs incurred throughout the year. So as we incur overhead costs, we debit overhead, and we credit a variety of different accounts. I'll talk about that in a moment. Notice, all amounts credited to the overhead account are estimated amounts applied or transferred to work in process using the predetermined overhead rate, POHR, predetermined overhead rate. Okay, let's take a look at this slide here. As we incur overhead costs, we debit overhead and we credit the various accounts such as accumulated depreciation, utilities payable, prepaid insurance, supplies, salaries payable, and other accounts. Now let's think back to financial accounting, and you may not have taken that for a while, but let's just think back anyway. In financial accounting, we debited depreciation expense, credited accumulated depreciation. We debited utilities expense, credited utilities payable. Debited insurance expense, credited prepaid insurance. Debit supplies expense, credit supplies. Debit salaries expense, credit salaries payable, etc. Okay? That was in financial accounting. In managerial accounting, what we're doing is we're capturing all of these overhead costs in the cost of our product, and the term that we use is we are capitalizing these costs. Capitalizing costs means that they will be shown as part of the cost of inventory on the balance sheet first. When the inventory is sold, and remember, raw materials, work in process, finished goods, cost of goods sold, when we sell the inventory, then it hits the income statement as part of cost of goods sold, which again is an expense. Okay? So we capitalize these costs. In financial accounting, we expense them. They went straight to the income statement. Here, they're going on the balance sheet first because they're part of the cost of building our product. So we have to include those overhead costs in the product. So we capitalize them. When they're sold, they hit the income statement as cost of goods sold. All right, so let's take an example of the predetermined overhead rate. Estimated annual overhead expenses, $2 million. Estimated annual activity, we're going to use machine hours in this example. So 2 million divided by 50,000 machine hours. For each hour that the machine runs, we have noticed, based on past experience, that collectively we generate about $40 of overhead costs. Remember that 2 million includes all the various different overhead costs that we mentioned earlier and a lot of others. Okay? So every hour the machines run, we charge $40 of overhead costs to work in process. Because remember, each job has 3 product costs: direct materials, direct labor, and overhead. So we're talking about overhead here. If the current job that we're working on has used 600 machine hours, then we will apply, which means transfer or assign $24,000, which is 600 hours times the $40 per machine hour. We're going to charge that particular job $24,000. Here's our journal entry. Debit work in process, credit the overhead account. I'm going to go back to the previous slide right here. Now the problem is, let's just say we pay property tax twice a year, in April and in November. But it's now mid-May, and I'm almost finished with that particular job. I don't know how much property tax to charge that particular job. But I have to record my overhead costs as I incur them, but the bills come in unevenly throughout the year. And so it's difficult to know exactly how much of each of these overhead costs to charge to the product. Okay? So the debits, as we incur these costs, we simply keep track of them. We debit the overhead account. But once we've established that overhead rate, then we simply apply the overhead rate times the number of hours or units or whatever it may be to each job, so that we're able to know relatively accurately how much cost we've accumulated in each job. We can't wait till we receive the November property tax bill or pay insurance or whatever other costs we may incur. Okay, this allows us to quickly and on a timely basis know roughly what the costs are in any given job. Because once we finish the job, we're going to ship the goods, and of course we got to bill the customer because we need to get paid. Okay, so again, job used 600 hours, debit WIP, credit overhead. We saw the previous journal entries. Again, it's easy to identify the direct materials. These are the main parts of your product. Direct labor, you can measure direct labor. Overhead's a lot trickier. So we use this overhead rate to charge overhead costs to each job. When a job is complete, okay, we've captured our 3 product costs, okay. Now, we have to do a couple of things when a job is finished. First, we divide the total costs right here. So let's say this job number 1 is finished. Okay, we add up direct materials, direct labor, and overhead, and we get the total cost. We divide this number by the number of units for this job. So if we had to make 100 units, then whatever this cost is, we divide it by 100 units, and we know that what each individual unit cost us for this job. And that's good feedback. It lets us know, because we've built this product before, are we doing it efficiently? Did we have some inefficiencies? And then we can try to find the reason and improve our process. We're always trying to run our business as efficiently as we can. Okay, so we divide the total cost of the job by the number of units produced for that job to determine cost per unit. Second, we have to transfer these costs out of work in process into finished goods. That's the next step in the flow of costs. Okay, so let's just say, for example, this particular job cost us $300,000. That's my direct materials, my direct labor, and my overhead. We produced 60,000 units to fulfill this customer order. 300,000 divided by 60,000 units it costs us $5 per unit. Now we would compare that to previous jobs where we made pretty much the same product. Okay, might have been some little cosmetic differences. We can see, did we do it efficiently, inefficiently, and we can investigate the reason why. Okay, the journal entry to transfer costs out of WIP inventory into finished goods inventory. Remember, these are both assets. So when you transfer goods out of inventory, it's going to be a credit, and when you put an amount into inventory, it's a debit. So it's going from WIP to finished goods. Debit finished goods, 300,000. Credit work in process inventory, 300,000. Upon sale, remember, just like in financial accounting with merchandise inventory, we have 2 journal entries in a perpetual inventory system. First, record the sale at the retail price, or whatever you're selling it to your customer for. It may not be a retailer necessarily, but debit either cash or accounts receivable, depending upon if they're paying cash or if it's sold on account. Credit sales revenue. Second, we have to record the cost of the sale. Okay? Debit cost of goods sold, credit finished goods inventory. These journal entries are identical to a merchandising environment, except this credit here, this would have been merchandise inventory. Instead, it's finished goods inventory in a manufacturing environment. That's the only difference. And now we've completed the flow of costs through a production process. Now, let's just take a look at this slide for a moment, because anytime you deal with an estimate, you know that it's not going to be right smack on the money. Hopefully, it's reasonably accurate, and if it's not, you got to review all the assumptions that went into your calculations, because something must have changed, and you need to update those numbers to make them more accurate. Okay, let's take a look at this. At the end of the year, the total debits and overhead, which are the actual costs incurred, may be different than the total credits to overhead, which is that estimated amount based upon my overhead rate. Okay? If there's a difference, which there will be, there always will be a difference. It might be over, it might be under. Any difference is transferred to cost of goods sold. For example, actual costs, the debits for the year were $250,000. But using my overhead rate, I only applied or transferred $248,000 worth. So I was short. I under-applied overhead costs by the amount of $1,500. Okay? If my estimate was perfect, which it never is, but had it been perfect, I would have transferred all $250,000. Well, at the end of the year, all of my bills have come in. I now know what my actual overhead is. I may have finished several jobs throughout the year, so I needed to estimate overhead, but now I know the exact amount. Okay, so I've got $1,500 of overhead sitting there that it's a cost I incurred for these jobs. What do I do with it? And as long as that number is considered to be immaterial or insignificant, we simply charge it to cost of goods sold. Okay? And the journal entry is simply debit cost of goods sold, credit overhead. I want to talk about this just for a moment. Technically, if you think about it, that $1,500 could be spread out in 3 different spots. It could still be sitting in work in process, some of it. Some of it could still be sitting in finished goods in the warehouse, and some of it may have actually been sold. Okay, but to figure out which part of the 1,500 is in work in process, which part's in finished goods, which part's in cost of goods sold, that's difficult. And if it's an insignificant number, it's not really worth the time. And you know that eventually everything's going to get sold, so it will end up in cost of goods sold. Okay, so it's common practice to simply charge cost of goods sold when there's a balance remaining in the overhead account. Now in this case, we actually incurred $250. We only applied $248.5. We under applied overhead costs by $1,500. There's the journal entry. Okay, and notice the credit to overhead of $1,500 will zero out the account. Had the opposite occurred, okay, instead of $250 debit, $248.5, suppose this was $252,000 credit, then we actually charged more overhead to the products than we actually incurred. So it's $2,000 that doesn't even exist. We're going to correct that inaccuracy in the estimate. And again, the amount is assumed to be immaterial. And the journal entry will be the opposite. Okay? We had $250 and $252. I'm going to debit overhead for $2,000. That'll zero out the account. And I'll credit cost of goods sold because we charged more costs than we actually incurred. So this kind of corrects the imperfection in the estimate process. Okay, last, selling and administrative expenses or operating expenses. Let's review the multi-step income statement. Okay? Sales minus cost of goods sold equals gross profit minus operating expenses equals operating income. Okay? And we know this is not the end, but we don't really have to talk about what goes below operating income. Okay, these are my product costs. Whoops. Direct materials, direct labor, and overhead. We capitalized those costs because they were on the balance sheet first, and they didn't hit the income statement until we sold them. Operating expenses, which we know are my selling expenses, and my administrative, I'm just going to abbreviate, admin expenses. Sometimes this is called selling, general, and administrative, or SG&A. Okay, these are my operating expenses, and we refer to these as period costs. And the reason we call them period costs is that when we incur them, whatever period, time period that we incur them, they go straight to the income statement. They do not get capitalized. They don't go on the balance sheet. They go straight to the income statement where they show up in the operating expense section. So we treat them a little bit differently than our product costs, which do end up on the income statement as part of cost of goods sold when we sell the inventory. Okay, and that is job order costing.